Hello and welcome to Free Lunch here at Zacks. I'm your host, Ben Rains. The Dow, the S&P 500, and the Nasdaq all fell in morning trading Thursday as the market volatility continues. Stocks did bounce back on Monday and Wednesday after all three major U.S. indexes tumbled into a correction last week as the coronavirus spreads outside of China. Wednesday's climb might have been spurred by Joe Biden's strong performance on Super Tuesday, but investors should prepare for more ups and downs as the coronavirus cases spread in the U.S. and elsewhere, because the economic downturn won't be understood for some time. With this in mind, U.S. lawmakers passed an $8 billion emergency spending package on Wednesday to help fight the coronavirus, and the International Monetary Fund laid out plans for $50 billion in lending programs. Plus, the Fed announced on Tuesday that it cut its benchmark interest rate by 0.5 percentage point, and if recent history is any guide, another rate cut could be coming. The Fed has cut interest rates 6 other times between regular meetings since 1998, and the central bank then lowered those rates again at their next policy meeting, according to the Wall Street Journal. Investors will soon turn their attention to February's jobs report, which is due out Friday morning. A similar report, the ADP National Employment Report, showed that U.S. private sector added 183,000 jobs in February, which would suggest that the U.S. jobs market continues to hum along. Moving on, Kroger stock climbed 5% Thursday morning to brand new 52-week highs after it topped our Q4 earnings and revenue estimates. Looking ahead, fellow retail and grocery giant Costco reports after the closing bell today. Meanwhile, United Airlines stock fell over 5% after it said that it would cut its domestic capacity by 10% and international flying by 20%. American Airlines stock then tumbled 8%, and other travel industry stocks fell as well, including Wynn Resorts, Booking Holdings, Expedia, and others. United and Boeing were the Dow's biggest losers in morning trading Thursday. Another company has quietly, or maybe not, surged during the downturn. Netflix shares have climbed 8% since early last week, and Netflix stock is now up over 20% in 2020 and 34% in the last 6 months as it races towards its highs. And that does it for the news portion of Free Lunch, but stick around for today's new Zacks Rank #1 strong buy stock.
For today's tech tip, we are going to be looking at how to access a free analyst report for any of the stocks at Zacks.com. You'll start on the home page and navigate to the top right search bar. Type in the ticker you're most interested in seeing. From here, you'll move to the left-hand toolbar to find the free analyst report under Zacks Research. Type in your email and access your free report.
Hello and welcome back to Free Lunch. Today we're breaking down why ResMed is a Zacks Rank #1 strong buy stock. ResMed helps people with sleep apnea, chronic obstructive pulmonary disease, or COPD, and other chronic diseases. The company's cloud-connected medical devices help people stay healthy and live more comfortably at home or wherever they are. ResMed shares have soared in recent years, and it topped our second quarter fiscal 2020 earnings and revenue estimates at the end of January. So we're going to jump right in. As always, I like to take a look at the company's website. So as I mentioned, they offer sleep apnea and other portable oxygen devices for people who have COPD, other diseases, and sleep apnea, which is a very common thing, especially here in the United States. So you could peruse their website if you want, but we'll go to their investor relations page real quickly just to understand. They pulled in $2.6 billion in revenue in fiscal 2019. Their adjusted earnings grew over 9% over the last 5 fiscal years, and they returned, this is something definitely to note for investors, they returned 63% of free cash flow to shareholders over the rolling 5-year period as well. So now we're going to go ahead and take a look at some of their stock price movement and overall revenue growth before we take a look ahead. So far in 2020, the stock is up about 10%. This compares to its market's about 2.3% decline, and we obviously know that the market has taken a tumble pretty quickly over the last couple weeks as well. But if we jump out over, we'll go to the last year, we can see they're up about 70% over the last year. And then if we go back even farther, we can see the company's really gone on an impressive run. So they're up about 160% in the last 5 years. And then we can see that over the last decade, this has certainly been a great stock to own, which trades under the ticker RMD. They're up about 460% compared to their medical products market average of about a 93% climb. And now we're going to go ahead and take a look at some of their recent top-line growth. So 2019, overall, they grew their revenue by about 11.4%, 13.2% the year before that, 12% the year before that, 9.5% the year before that, 8% the year before that. So some steady and solid top-line growth for this company that operates in the sleep apnea and COPD segment of the medical devices industry. And now we're going to go ahead and take a look at what to expect going forward. So for Q3 2020, we're calling for about another 9% top line growth, about 11.3% growth on the top line this year for fiscal 2020, and then another 9% growth in 2021 and 11.3% growth in 2020. And then on the bottom line, we're calling for about 18% bottom line growth this year, and then another 9% bottom line growth in the next year. We can see that over, since they reported, their earnings revisions have trended completely upward for their current fiscal year and the next fiscal year. We can see that jumped from $4.11 to $4.29, and from $4.60 all the way up to $4.68. We could also see that they have easily topped our bottom line estimates over the trailing 4 quarters. They had a big beat last quarter, about a 20% beat, and they've beat by about 9% over the trailing 4 quarters. And along with this really nice price growth, the company does also pay a dividend. It's yielding at about 0.9% at the moment, which is kind of on par with the 10-year U.S. Treasury, which have jumped so low recently. But the reason for this really relatively low dividend is the stock has moved in such the right direction recently that, so along with that growth, you're getting a little bit of a dividend, and you're also getting some big top and bottom line growth. And this is certainly a stock to consider at the moment for all the reasons we just touched on. So that does it for another episode of Free Lunch. Make sure to also check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. Also, make sure to tune into Paper Traders, which is live at 11 a.m. on Wednesdays. Once again, I'm your host, Ben Rains, and we'll be back next time with more up-to-date market news and a new top stock pick.